All right, so I think we'll officially start and folks can keep joining. Well, thank you all for joining today's session. We are very excited to have you all here on the session around can IT services companies exit? Very pressing question for a lot of founders who are running services companies. Their blood, sweat, and equity goes into the whole building organization and running that through and sorting out all the challenges that they face. But then what is the ultimate exit for them? Before I move further, I would want to welcome you all on behalf of PASHA, Pakistan's National IT Association. We are about 1,000 members strong, had been there for the last 30 years, almost close to 30 years, and have seen a lot of different changes within the landscape of IT and technology here in Pakistan. Just to put a context out here, because a lot of people are non-PASHA members and it was an open invite for others to join. Pakistan's IT and technology landscape evolved over the last 30 years. In late 90s, of course, Pakistan was also a services destination for a lot of companies across the globe, especially in the West. And we have seen a lot of services companies emerging in late 90s, which are a big giant or bigger organizations right now and serving globally. And then over the last 20 years, I would say we have seen a lot of interesting direction. Post 9/11, there was a lot of challenge for the IT and technology world for Pakistan. We had to face all those odds that any country has to. But then again, a lot of new breed of IT founders came into being in mid 2000s and close to 2008, 2010. Those IT services founders kept on building up their services companies, and those services companies further then started investing into newer ideas and products along the way. So from 2010 onwards, we started seeing a lot of first checks coming in from those services founders into startups. And then the startup ecosystem started building up and the product companies started coming forward as well. Over the last 8 to 10 years, I would say we have seen a lot of growth in innovation and knowledge economy here in the IT sector. And a lot of leading product development organizations came forward, building up solutions or products for not only Pakistan itself and solving pressing problems within Pakistan, but also globally. And then we also see that a lot of research and innovation platforms for a lot of large scale, I would say some of the unicorns also got established here in Pakistan. And the whole journey continues with all the challenges and odds that we face day to day, which is kind of, I would say, an encouraging fact for the IT industry here, because no matter what happens, IT and technology still is a key growth lever for Pakistan as an economy. And then globally, Pakistan is very well positioned for these kind of I would say support, or I would say research and innovation driven activities that global organizations demand. Without further ado, I would like to introduce the panel, starting with myself. This is Jamil Gohir. I'm one of the board members of the IT Association this year, but on day-to-day basis, I'm one of the founders, started up this company called Qualitatum, which is an independent software testing quality assurance company based out of US, Middle East, Pakistan, heavily working in the US and Middle Eastern market and leveraging the back office as well as talent pool here in Pakistan and globally. We are not only a services company, but we also, based on the last 10 years of experience, built up our own product, which is a software test lifecycle management system. So for the last 14 years, building up a services company, taking it global, making it a TMMI level 4 certified company globally, ranked in Gartner a few times. We also built a product, and now I'm juggling around how to balance the two things together. So a lot of questions that we'll be asking today are also my own pressing questions. I would quickly move on to, so three panelists. I would like to welcome Athar Suleiman, who is an ex-CEO of Flux, Darin Cook, who is an ex-CEO of SynchroNet, and Steve Lee, who is from Layer 7 Capital. I would let them introduce themselves, starting from Athar. Please talk a little bit about where did you go to university or school, what was your experiences, and lately what you are doing after exiting from Flux 7. And then similarly, I'll move to Darin and then Steve. Over to you, Athar.
Sure thing, Jamil. Well, first of all, thank you everyone for having me. Really appreciate the opportunity. So I went to school, engineering school at UT Austin here in Texas. And went for undergraduate and then grad school And I started my career actually in hardware design. So I was a chip architect working at Intel. And during those days at Intel is a pet project of mine, a side project really, transitioned my career from being a hardware architect to being a cloud architect, which then led to me founding Flux 7 with a friend of mine. And we started the company in 2013, and the company had its own good run. We were quite successful in the AWS domain. I became an AWS Premier Partner. We were also awarded the AWS Partner of the Year for Central US in 2017, and so on and so forth. In 2019, we got an acquisition offer from NTT Data Services, the global behemoth out of Japan. So we decided to take the offer and exit Flux 7. So that was the experience till Flux 7. Then after doing a couple of years at NTT, I moved into my next venture, which is what I'm doing right now. So we have just founded a startup accelerator named Wixel. Unlike your typical startup accelerator, which there is actually over 1,000 in the world right now, they are all focused on SaaS or product companies. We take a contrarian approach, and we built an accelerator that's focused on purely IT services companies exclusively. And we have had graduated one cohort of startups, and the second cohort just started last week. So just learning and growing the accelerator as we go.
Awesome. Over to you, Darin.
I echo Otter's appreciation for the opportunity. Actually, I never graduated college. I chose the military as my education, and then started out in sales, actually in technology sales. Grew into an executive role with a telecom company, Time Warner. Was there for a number of years, and then in 2012 decided to scratch my entrepreneurial itch and joined a group of investors and owned and operated a data center here in Houston, Texas. So we had that asset for about 5 years. We had a successful exit, and then I bought the majority interest of a small company called SynchroNet that we wanted to use as a platform to enter into cloud. So we transformed it into, from a pretty typical US-based managed service provider for small business, and we transformed that into a AWS partner. So we chose to focus on a particular technology, the virtual desktops inside of AWS, and then became really the global expert for that technology. We had that service business. We actually built a SaaS platform inside of that service business. And then we had a successful exit in 2021 to Software One. So a Switzerland-based Microsoft licensing company who wanted to enter into the services business.
Awesome. Steve, over to you.
Thank you. I'm extremely honored to be here with all of you. I feel kind of overwhelmed by the talent and the entrepreneurship. So looking forward to learning more about the group over time. I don't have a technical background. I was a political science major at UC Berkeley. I went to law school at Harvard, practiced law at the beginning of my career. Spent my early years working for the big investment banks that you probably heard of, people like Bank of America and Merrill Lynch. Spent some time at the Carlyle Group, which is one of the large private equity firms here in the US. For the last 18 years, I've been a boutique investment banker. So instead of working with Fortune 500 businesses, I work with small companies like Flux 7 and SynchroNet, helping them, first prepare for an exit and then ultimately find buyers for that business. And in the IT services space, my career really began with digital infrastructure businesses, so traditional telecom, data centers. And then I started to move up the stack. So started to work with the nascent cloud services and technology businesses. and more recently, digital transformation consulting companies, people who focus on AWS, Azure, different SaaS platforms like ServiceNow and Salesforce. We, as a firm, just started a peer group of consulting companies that focus on AI. So we actually have our inaugural peer group meeting later today with about a half a dozen AI consulting firms. Lastly, I've been an investor as well during the course of my career. Have made about 15 investments, mostly in companies that are at the early stage, but not at the venture stage. And of the 15, have now exited out of a dozen of them. So I have some sense of what it's like to grow a business and ultimately sell it to a buyer.
Awesome. Quick question, 12 exits. How many of them were services companies and how many product companies?
So I am currently an investor in a product company that does search engine optimization. And we haven't exited that one yet. The rest of them are services businesses, but some of them do have infrastructure. So some of them were data center and hosting businesses.
Very nice. So one thing is for sure, no matter what path you take in terms of your education or career, you can always follow the love that you have for building businesses, and you can always converge and connect to anybody and everybody in the world. Awesome. So thank you for the introductions, guys. I would want to open up the discussion from building up a perspective around how the technology future looks to you all, especially in the frame of IT services companies. What's the future of IT services companies? Because we have seen over the last 2 decades, there was a lot of product-driven, I would say, investments happening. There are a lot of SaaS-driven investments happening over the last I would say, decade or 10 years. A lot of hyper scaled investments going into businesses which are growing very rapidly. But then recently we have seen that there is a lot of thought process around how to build services business to a point where they can find an exit. And then a lot of larger organizations are looking for talent pool and out there. So would love to pick up on thoughts around the IT services future. Let's start with Atir, then we'll go to Darin.
So I guess I'm going to make a very bold statement here. I actually believe that this decade is going to be a lot more about services than just pure SaaS platforms. And the reason behind that is that I think the technology just follows this progression. The software only kind of solutions get picked up first because that's easy. Everyone kind of starts right there. So examples of that would be product-led growth by platforms like Slack, for example. But as those platforms actually get to either larger enterprise customers or the complexity of the products go up, you need more people to just do hand-holding. Like installing Slack in a startup is equivalent to go to slack.com, plug in your credit card, and you're done. But installing Slack for a 50,000 person organization like Entity is a whole different beast. And that to me is where services comes in, which is product companies or software only companies, if I may say, provide a solution. And then there's the customers and there's a gap in between where IT services comes in. And as the low hanging fruit on software only services gets picked up, or even when those services that started with product-led growth mindset 7-8 years ago now enter the enterprise market, they realize that there's a totally different kind of resistance to a product that was thought to be incredibly easy to use, has now become pretty difficult to use when you're bringing it to a 50,000 person organization. So consequence of that, I think there's a 7 to 8 year life cycle on those things. And then you start seeing pure product companies start to build or partner with services organizations. Slack is a really good example of that. About 2013 is when they took off, about a decade in, and right now Slack's recruiting partners right and left, trying to get help to install these in the more complex enterprise environments. And so I think I actually feel that the last decade, there was a lot of enterprise software evolution that took place. And this decade, there's going to be a lot more, the pendulum is going to swing in the other direction with a lot more help, hands-on keyboard help needed to install these in more complex environments. And also the new age of softwares will not be software only, but rather have more of a hybrid approach to them. So that's kind of my take. Like I said, a very, very bold statement here, but that's the trend that I've been noticing.
Awesome. That's quite encouraging for all the services founders to really look forward to something happening for them. Darin, what's your point of view?
Very, very similar. I mean, the velocity of the feature set associated with software in the market is just incredible. So I think the application, going back to Arthur's example, the reason that your, Slack is complex at the enterprise is you obviously have security, you've got different requirements, right? From a team and use perspective, the feature set associated with those platforms are incredible. So I'm very bullish on services across the board. And I really think it's going to be a different approach dependent upon what market segment you want to focus in on, right? So if you want to go after the mid-market, let's say, $500 million to maybe 2 billion, that's going to be a much different approach and service set that you're going to take to market than if you're going for larger enterprise. But regardless, across the board, what I'm seeing even today is, customers really needing help. And with that, I would say that service companies are going to have to be better at the soft skills of identifying exactly what their customers are looking for, not just supply the technical know-how to be able to deploy the technology, but that middle layer, let's call it business analysis or the BA, whatever, program managers that are really going to be able to understand what the customer is trying to achieve and then be able to wield the technology to accomplish those goals.
Absolutely. I think the way different stages of a software IT services company exist, their demand is continuously growing in terms of the talent required by global organizations to fulfill their IT and technology needs. As digital transformations are happening, everybody is basically looking for talent, and then the freelancing talent is not available. The individual hiring is always a challenge. And then that's where niche organizations probably are a very sweet target for those larger organizations to acquire or merge into so that they could be able to address those needs. And that leads me to a question for Steve. How do you see the trends? What are the key areas where you see a lot of potential for IT services companies to focus, and the kind of services skill set, the technology stacks, or the industries where there is a continuous demand for a potential for an exit for those organizations as well?
Right. So I think most people, when they're making an investment, wants to see where the puck is going to go and try to predict that future and aim for that future. I think there's some risk in that strategy because you could be right or you could be very, very wrong. And it's hard to know in the time cycle where you begin a business, because typical exit happens 5 to 10 years after the founding of the business. And as we all know, technology changes very quickly. But here's a cycle that you might want to think about. There's a difference in valuation and metrics that people use for valuation, depending on the maturity of whatever ecosystem that you play in. So go back to when Arthur was an owner of Flux 7. I would say there was an early days for AWS services ecosystem, and companies that had a premier consulting status in North America, for example, were roughly 30 companies at the time, and half of them were the largest GSIs, people like the Accentures of the world. So if you're one of the 15 small companies that could be acquired by somebody else, there was a scarcity value, and people were willing to pay a price that's not necessarily dependent on the financial profile of the business. So you saw revenue multiples, and it was essentially an acqui-hire. And I think that's what happened with NTT Data with Flux 7. As the industry matures, you tend to be valued more on your cash flow, so EBITDA of the business. So ultimately, you got to think about, are we trying to catch a falling star at the right time, at the right place, or do you want to build a fundamental business? And is that a business that you're willing to hold on to for 10 to 20 years? And depending on what the answer is, I think your approach might be somewhat different. So I don't know if that answers the question, but I think there are a lot of nuance in the question that you asked.
And then in terms of the trends, where do you see a lot of potential for services to grow? For example, there is a lot of demand. I was looking at some numbers where they say that there is a 4.2 million jobs in the next 5 years required by Salesforce. There's a lot of demand around AI these days, where almost every services company have some kind of a thought going on, if not an action going on, around building up an AI team so that the demand can be fulfilled going forward. We have seen a lot of services companies building a lot of blockchain resources together in the last few years when the cryptocurrency came in. How do you see the next 5 years?
I think AI is definitely an area where you're going to see a lot of activity. Up until now, there weren't that many AI companies at scale. And we've been following probably 24 AI businesses from 4 or 5 years ago. At that point, they were doing 1, maybe 2 million of revenue. Many of them are getting up to 20 plus of revenue in a short amount of time. So those companies that were early adopters and pure play AI services business, there's going to be some interesting and high valuation transactions in the future. You also mentioned Salesforce. So we actually sold a company called DocNation, which is headquartered here in the US. Roughly 70% of the employees were in India. That was acquired by a private equity firm and merged with 2 other businesses in the Salesforce ecosystem. And then within about a year and a half, the private equity sold the business into public group for about 4 times what they paid for, which was a fantastic return. So when you look at that ecosystem, one thing that you might consider is Salesforce has its traditional CRM system, which has been around for 20 plus years. Companies that focus on that, the Sales Cloud portion, they're not necessarily that unique. The company that we were working with, they were focused on commerce, B2B commerce, which was an acquisition, Cloud Craze, that Salesforce made. There are areas within the Salesforce ecosystem that after a recent acquisition, Salesforce really focused their sales dollars. And if they had a leading partner, they were willing to feed them a lot of deals. So DocNation was growing at about 100% every year for 3+ years. So if you were at the very beginning of your journey, not just look at something like a Salesforce as a monolithic entity, but within that ecosystem, try to figure out, what are the areas that are the highest growth? And, maybe if I'm starting fresh, that's where I would focus on first.
Okay. Arthur, do you want to take a quick stab at that as well, in terms of your exposure during your Flux 7 exit, as well as now building and running an accelerator program? Where do you see the future of IT services companies and the key trends out there?
So I think I'll echo the last part of Steve's answer, which is it is about finding the niche, in my opinion. And Steve's absolutely right in that if you find the right niche, you actually can get, for the lack of a better word, oversized returns and actually get better valuations. There's obviously a risk involved when you go after a niche business, as Steve also pointed out. But then I do believe that there are predictors. So this is where I think my research comes in, is that there are predictors that you can actually see of what's happening, because that's one of the benefits we have as a services company. Pivots are a lot less expensive because we don't have a lot of IP baggage that we are carrying if we invest in one technology. So that you have more opportunity to do market test and see what's going and what's not. So my personal number is 2 years, which is whatever niche a services company is going to pick today. In 2 years, they're going to be working on a different niche because industry is going to move that fast. And again, we're always bridging that gap between the product and the customer. The product is constantly trying to bridge that gap as well. And once that gap gets to a certain size, the room for services companies shrinks, and services companies have to find a new product to be bridging that gap for, if that makes sense. And Steve's right, Salesforce is not monolithic, neither is AWS. So when our first niche in the market was bringing containers to AWS, and we kind of rode that wave from 2014 to about 2016. The next one became Terraform with AWS, and we roughly rode that wave from about 2016 to 2018. Then we got pretty big into creating AWS landing zones because the enterprise adoption was happening and security became a more first-class citizen. So I think that's kind of the general framework that I use. But then there are some very important basics that you can look at, right? Because one of the benefits being a services company is that you're typically going to be following a product trend, not necessarily establishing a trend. So there's a lot of research that you can do on, for example, what products are taking off what products are taking off, and they're complex, so that somebody's going to need help installing them. And in fact, I do encourage founders to look outside the box. For example, saying we just do AWS infrastructure as a service today, frankly, in 2023 is commoditized at this point. It's not a specialty skill at all. But at the same time, when I was working in the AWS ecosystem on containers and Terraform, in fact, left to Darin for chime in, Darin actually found a completely different niche, which was let's just go after desktops in AWS. And that's a great example of looking at AWS as a platform, but finding one niche inside of it. And that enabled them to parachute very quickly to being a pretty big name in that niche within the AWS, even though they were relatively late entrant compared to us. So that's kind of the general framework. But
a quick follow-on question. I mean, when you're building a niche and you said that it would probably stay around for a couple of years, 2 to 3 years, and then you have to pivot again. How do services companies think of staying a beast? Because there's a cycle of building up your own sort of a skill set within the organization. And then once you are, let's say, able to serve that niche and the industry is changing, then you have to change the whole skill set around as well when it comes to the human resource. How do you see solving this kind of a problem within a services company? And just for context, in Pakistan, there are multiple models going on. There are services companies who are very tech stack focused. Let's say people have a 50 people team for mobile and Android. People have a 25 people team for Ruby on Rails. So there are multiple tech stacks, and there are services companies who specialize in those tech stacks. Then there are companies who have a resource augmentation model. Okay, we'll basically recruit a resource and we'll add a resource. We are technology agnostic. Whatever is demanded by the organization, we'll pull up and build that kind of a workforce within the organization. And the organizations are growing very rapidly here in this model as well. We have seen phenomenal growth with few companies growing from, let's say, 50 people to 800 people within the last 2.5 years. And there are 3 or 4 examples that exist. There's a third kind of, I would say, services sector as well, which is very industry focused. Let's say I am solving problems in financial and banking sector, and I have all the services and exposure built around banking. I am the domain expert. So come to me and I'll solve those problems. Similarly, I'm a healthcare, I would say, services company, which is focused on the healthcare area, and come to me and I'll solve problems for you in terms of healthcare. Now, with these 3 models, primarily this is what exists. And then larger organizations, they have almost like everything going on under their umbrella because they are big enough to create those small business units within a larger business unit and have multiple niches across and continuously keep on scaling. With this context, how do you suggest an approach for a services company to think forward?
So I think there's multiple aspects of that question that I would maybe touch on one by one. So to answer the first part of that question, which was, well, how do you keep up with that innovation that's happening in the market, like every 2 years? I think that's actually kind of what sets apart a services company that's innovative versus a service company that becomes stagnant and starts to taper on their growth. when they're not innovating fast enough. So what I always used to say when we were at Flex 7, we had this loop that we used to call, we're always learning something, we're always delivering something, and we're always abandoning something. Because so everyone talks about continuous learning and continuous improving your delivery practices, but you have to be abandoning stuff as well, stuff that's now getting commoditized. Unless you want to become a commodity player, you always have to be removing some of the skills and resources. So, for example, as containers became a commoditized service by 2018, I was just using my example earlier. If you went to the Flex 7 website in 2018, containers was not even a word mentioned on our website anywhere, because that was a commoditized service by that time. And it was, yes, we would do containers, but it was a Me Too play. Everyone else was doing it too. If you come to Flex 7, we will, and by the way, we'll also do containers, but our main focus is security on AWS, putting enterprise grade landing zones into AWS. Containers just happens to be a part of it. So I think it's a constant cycle that you have to run. And that's the upside and the downside of being a niche player. That the upside is, frankly, it's actually a big motivator for your staff, because people are driven by learning new skills. And when you build a company where you are, instead of, say, servicing a 10-year-old technology, you're always learning something new as an organization. You actually motivate a lot more people in your organization. It's actually a technique where retention becomes higher, because people like to learn new things. You have to invest in them, and you're doing it for them and for the business. It's just a strategy, if you will, in how you play it. Rather than opening new business units, we would actually abandon skills that had become less interesting to the market and to our team as well. Coming back to the second part of that answer, I think you said 3 types of models. The kind of the niche player, multiple business units, and the one in the middle that you had, I would call that just staff augmentation, for the lack of a better word, where you're just providing resources, whatever is needed. So frankly, I think it's a personal preference. I'm a lot more interested in being a solution provider any day than being a staff provider. To me, that's just a labor business. And the other very business reason beyond interest is that staff augmentation companies do not tend to build a lot of equity. Stephen, Darin, I know if you'd agree with that, but the multiples at which they exit are a lot lower than if you're a solution provider, especially if you're a niche solution provider. So for those reasons, I would say being the niche player typically yields to more gratifying outcomes, both personally and financially, at least for me. And that, like I said, it's a personal choice.
Great. I'll quickly move to, yeah, go ahead, see.
Jamil, one part of your question was, you mentioned there are companies that specialize in certain skills and companies that specialize in certain industries. They're very different business models from your sales motion point of view. Companies that have a technology or skill expertise, they are more passive, in my opinion, on how they go to market. So they might have a partner, channel partner, or let's say you're in the Salesforce ecosystem. Salesforce itself may be your biggest channel partner, and you put yourself out there and say, I'm an expert on landing zones, right? And then you get all the lead flow because of that. Whereas if you're a industry-focused services firm, you tend to be much more offensive. You tend to have much more of a direct marketing effort because it's easier. Instead of trying to reach out to every single industry in the world, you could go to trade shows for healthcare companies or pharmaceutical companies. Given your limited resource, that's a much more effective focus, because you could become, within that industry, the go-to company for that service.
Awesome. I'll come back to this thing. I'll quickly move to Darin. What are your thoughts about how to build a niche within a services company, and how can a founder increase their valuation multiples building that niche out there in the services side? Probably your experiences building SynchroNet.
Yeah, so building a niche, it kind of goes back to basic economics, right? So when I was building SynchroNet, I'll never forget the day I sat down, with one of the partner representatives with AWS, and I was so excited because we were doing all these cool things inside of AWS. We had built a serverless app, and I remember he was sitting across from me eating spaghetti, and he's eating his spaghetti, right? And he's like, "Yep, okay, yep, you did some serverless stuff. That's cool. Okay, hey, we built this Alexa app, and it was cool. We connected it to the database." He's like, "Yep, yep, yep." And then I said, "You know, it's odd too, is we've been dealing with these virtual desktops." He stopped and actually it looked at me, and I said, "Okay, after everything that I said, that's what you got excited about." He's like, "Absolutely. We just don't have anyone, any partners in the ecosystem who can deploy that service." And at that point, we just started, doing more investigation and understanding what the total opportunity was, and it was fairly large, and it wasn't really sexy technology. Desktops are desktops, whether they're physical or virtual. And I had to sell a little bit my team on the idea of heading that way. We only had a basic knowledge of the technology at the point, but we saw the opportunity, and we just declared, and we went that way. Now, we were fortunate enough to be valued on revenue because of what Steve mentioned earlier, which was we were in that time where the AWS ecosystem, you could really differentiate yourself with growth, with specific knowledge set. I wouldn't say that I could do that again today. We were able to really, I would say we were luckier, right, than smart, at the time. I'm building a new business today, and it's a service business, and versus a technology niche, we're actually focusing in on a vertical. And it really goes to what Steve said. We're creating good case studies and stories that we can share with that industry vertical and talk about business outcomes and those kinds of things, right? So, having had both, we're more EBITDA focused on this business versus just pure growth. And we're also, focus in on a vertical, right? Because I know who my target customers are.
Awesome. Of course, timing is very important, and not every time the cycle repeats itself. Quick follow-on question. What was the multiple that you were able to achieve in terms of your exit on your revenue?
It was over 3 times.
3x. Okay. Arthur, any quick thoughts around how to build a niche? And then I'll go to Steve for a follow-on question.
So and I guess Darin said the key word in there. It's about differentiation, becoming unique, whether it's through a vertical or through a technology. It's the strategy is the same. I will talk a little bit more about from the technology standpoint, because that's where my experience has been the most. So the kind of things I look for right now in kind of advising companies to find a niche is look for a software platform or a tool that's fast growing, typically a Series D or a Series E, focused on B2B. Say that company has about 1,000+ employees and is a complex product. It's not something that's a point and click deployment for an enterprise. And just within those 4 or 5 criteria, today there's about 50 companies that meet that criteria. Just to give you some out there examples that people generally don't think about. For instance, Circle CI. You don't hear anybody talk about, I want to be a Circle CI partner, but they're actually an excellent platform to be building services today on. They're upcoming, they're meeting all of this criteria. They are seeing leads right and left, don't have enough partners. You join Circle CI today, they will actually give you leads. You have the opportunity to be a differentiated partner. And at the same time, Circle CI has reached that size, that the critical mass, that they are stable. It's unlikely that they're just going to disappear on you. So it's a safe bet to make. Another such example would be Airtable, doing really well. The biggest partner in the Airtable space right now has just 12 consultants. Massive opportunity for somebody to tap in. 5 years from today, consolidation and exits will start to happen. So that's from a technology standpoint, those are some of the things you can look at in a couple of examples.
Awesome. Steve, what do you think? How can we build or define a valuation for a services company? What does a founder need to do in terms of creating that kind of, what are the key elements that define the valuation for a services company? And then how should a founder think about multiples and exit strategies?
Yeah. I mean, the punchline that I think everybody's looking for is, what am I worth? What are some of the deals going to market for? So the time period between 2000 to 2022 has been the high watermark, not just for the public stock market, but also for private transactions. We have seen consulting companies go for as much as 4 or 5 times revenue. That is, in my opinion, an anomalous time period. I think if we come back 10, 15 years from now, companies that did sell even 3 times revenue are going to be, perceived as having a very good outcome. I started my career, by the way, before the dot-com boom, and worked in a number of IPOs as an investment banker, and have seen the ups and downs that have come and gone. So what are the main factors that I look for? Growth is super important. And Darin, I know your financials. There were a couple of years when you were growing 100% every year, right? That is not that common. Arthur, you have consistently grown 50% for many years. I mean, not every single year, but that's a sign that you caught something. You caught the tiger by the tail, and that's going to result in a good multiple. Companies that are growing at say 10, 20% a year, which for a traditional business is a very good growth rate, they're not going to get a revenue multiple in the 3, 4, 5 times range. It's in fact going to be most likely valued as a EBITDA multiple. Second thing that people look for is scarcity value. So, Arthur was one of 15 premier consulting partners that you could acquire. You can't acquire Accenture. And there were many GSIs that wanted to get that certification so that they could have the bona fides to go to their Fortune 500 customer and say, we're one of the 30, including the large GSIs, who have this status. And people are going to pay up for that. What is the premium for having that scarcity value? Probably anywhere from 25 to 50% of where the market is. The third thing I think is really just execution, just being a good company, great financial records, being able to show good KPIs, having the discipline of not just being a startup, but being a good company, having good management, being able to show well. So in any sale process, you got to get in front of people, and you got to be able to speak to investors and counterparties on why you're a good business and a good leader. And that's something that, I think a lot of technologists, you don't necessarily learn how to sell your business and be a good spokesperson for the company. But I think that's something worthwhile practicing along the way. Other parts of execution include, how do you manage your people? What's your churn among your people? If you have a global practice, how do you manage the international aspect of your business? Do you have the right equity ownership and legal structure that's easily saleable? I've been involved in situations where, in order to affect the transaction, there was a partner. In one case, it was in India. In another case, it was in the Philippines. And you got to make sure you have the agreement in place so that it doesn't cause any issues in a transaction. So I think that's an area where you could bring in third parties and really make sure that you have all the preparation in place before you go to market. Lastly, where do I see multiples going, say, in the next 5 to 10 years? Well, I think if you're a hot AI company and you're basically doing rocket science for customers, you're still going to go for a very high multiple. You're still going to sell for 4 or 5 times revenue. But if you're in a more legacy stack of whatever, it could be an ERP implementation practice, it could be a Salesforce implementation practice, I think it's going to be something like 10 10 times EBITDA, maybe 1 to 1.5 times revenue, if you're considered a commodity service business.
Thank you. So growth, people, scarcity value, execution, churn, international aspect of the business, legal structure that exists, all of that defines how you'll be able to get a better valuation. So going to Arthur, any quick comments around the same question, considering that you are shaping up a lot of services companies in your accelerator program? How do you think about all of this?
I think I agree with Steve 100%. It is, and for us at Wixel, our thesis is that everyone that we work with, we want to push them. That's why we call it the ETS space, or the emerging technology space, because we don't want our companies to be in that the 1-to-1, as Steve called it, the 1 to 1.5x revenue. We want to actually push them to be more innovative and be focused on stacks that are more upcoming. So in 5 years, they are looking at that 3, 4, 5x revenue type of multiples. And I think I already shared the formula of how we are figuring out what's going to be big in the next 5 years.
Okay. Steve, how do you think a typical exit planning looks like for a services company founder? How early they should start thinking about it? And then, of course, based on all those few factors in terms of valuation, what are the key things that they should be looking at or building up during that time frame to shape up themselves for a potential exit or a merger?
Yeah. So number one, have a effective business that's growing quickly. I think you need that empirical history. Investors always hear about, as soon as we get our investment from some private equity or venture capitalist, our business is poised to grow 50, 100% every year. We just don't have the money. Unfortunately, when people hear that, it sounds like, my dog ate my homework, and that's why I couldn't grow any faster. So have that track record behind you. That's an obvious point. On a more practical side of things, really put your organization and build a institution around the organization. What I mean by that is, there are founder-led businesses where all the control, all the CPU part of the business resides just in the CEO and maybe his partner. So that's a big risk to someone looking to acquire the business. But if you build a proper team, both on the management side, on the sales side, then if the founder gets hit by a bus, then the buyer still has the assurance that this business will continue to succeed. That's hard for most founders, because the reason why they're founders is because they have the courage and in some ways pride to keep that control. But you gotta let some of that go and have a team of lieutenants that could take over if necessary, and they need to have that decision-making power. We talked about some of the legal things that should be followed to the teeth, right? You should try not to cut corners. You should make sure your taxes are proper and done in time. One issue that comes up over and over again, especially for international businesses, is this idea of nexus. A lot of countries, even if the company, the vendor, is not based in that country, requires tax payments in order for that business to be operating in a proper way. I had many clients who didn't follow that directive. So what happens is when the buyer comes along, they say, hey, you gotta make a representation in the purchase agreement that you've been paying your taxes. And if you haven't, we're gonna come after you for those taxes. And in fact, we know that you haven't been paying it. So it's better to do it right the first time instead of coming back and having to fix it afterwards. The third thing is getting an audit, and if not an audit, at least having a review from an accounting firm. Again, proper financial reporting when you're a closely held business is not the most important thing. But when you want to go and sell the business, people want to see a third party I guess, a stamp of approval that your numbers are correct. So if you do that early on in your history, that's going to help you a lot more. The last one that I'll mention is, having good systems for managing every aspect of your business. I'm not saying you should spend a lot of money to put different ERP systems, different human resources systems, but having a scalable set of tools to run your business, and making sure that it's the type of a platform that the buyer would be willing to kind of use afterwards. I think that's also, from an integration standpoint, something that could increase your value. I'm sure I'm missing a few other things, but those are some of the things at the top of my head.
Jamil, you
awesome. That's quite comprehensive. Thank you, Steve. Darin, how did your journey look like from thinking of an exit to an actual exit? Time frame, key things that you did, and the most challenging situation that you had.
Oh gosh, my business partner said he wanted to get us T-shirts that said "I survived the process." It's difficult, right? It's mentally draining. It's emotionally draining. I think for us, it was almost a year between the time that we said, "Hey, let's think about going to market," and when we ended up with money in the bank. So it's nothing overnight, and it'll never end up like you anticipate. It's a real journey. It can have a material impact on your business. To Steve's point about that, founder concentration associated with, the leadership of the business, intelligence, and kind of what's happening day to day. It is very important that you've got that leadership team that can lead day to day, because as a founder, you will be taken out of the business, of course, for meetings and things like that. But probably the largest impact is on your mental energy. You're going to be running through different scenarios in your head, and you're going to be thinking about the next meeting or what happened or what have you. So it burns a lot of energy to go into a process. So one, don't do it lightly. The other thing that I wanted to point out around, and Steve mentioned it under the category of execution, which is, you don't need to have sophisticated financials, but you need, as a founder, to be able to explain your P&L. You need to understand, your income statement. You need to be able to talk about your balance sheet. You need to be able to talk about your margins. You need to be able to walk through that at a high level. And then if you have some financial support, they can get into the details. But when you're positioning the business, you need to be able to talk about what our growth is, what our margins are, how are we going to take money, and put it to use, those kinds of things. So, I would say it's about a year from a timeline perspective, and you need to be thinking about 50% of your every day being dedicated to the process during that time.
Thank you. This is very helpful. So a lot of services companies, there's a very typical challenge for a services company that you must have seen, Steve, and of course, Arthur and Darin. You're always challenged by the revenue. You're a growing concern. You bootstrap, you pulled it off, you have a lot of customers, you're growing, but then your revenues are basically taking longer cycles. And as they're taking longer cycles, you're always challenged because you cannot have that money enough to really start some other initiatives around research or a couple of other areas, have more manpower. And then sometimes you also struggle in terms of fulfilling the timely payment cycles for your vendors as well as staff. How often did you see these kind of situations in your services companies that you were part of or looking at? And then how do you think somebody can be able to solve these issues, or what strategy should somebody take? Because most of the companies here in Pakistan, I would say, actually hampered because of these reasons in terms of the growth. They have a great service offering, they are growing, scaling, but not enough money and not enough venture capital in the services space leaves them stranded in the middle.
Yeah,
Steve, and then
I'll take that if you don't mind. Just first, be patient. You know, that's the greatest advice that I could give you. Be patient, be focused in on, unless you're in one of these really high growth areas and you've got comps around you that are showing, you know, you're wanting to exit, you know, at multiples of revenue. Unless you know that for sure, then you can start to lean in it, and you can get capital. Capital is no problem. The reason that companies have difficulty in sourcing capital is they don't have a great plan around it. You know, so you need to have a plan. You need to be able to talk about where you're going to put that that capital to use, and have proven execution, right? So it really goes back to, you really need to know what your margins are, know what your utilization is, know what your target market is, and what those uses of capital will be. If not, if you're really running your business well and you're on top of your receivables, you know, you've got tight language in your agreements that are going to allow you to navigate and have substantive conversations with your customers about payments. You know your margins, so you know when you're in these projects that it's gonna, you know, it is gonna yield cash, right? And so the symphony between, you know, driving revenue and managing your cash, it will be there if you're tightly managing the business, right?
Yeah.
thank you, Darin.
So
Steve,
these VCs almost never invest in a services business, and I think most of you probably know that. Why? Because, you know, they want that outsized return. The VC model is, you know, I'm going to make 50 investments, 100 investments, and one or two of them are going to become unicorns, and they know that others are going to fail. Actually, in the US, the VC model has become even something else. It has become more of a large size, mature technology secondary trading investment strategy. So you see VCs investing into the Ubers, you know, the Slacks before it became public, when they were already being valued at, you know, billion plus. So small companies have a very hard time raising capital right now because there aren't that many VCs kind of working in that small size range. So maybe this is somewhat different from Darin's advice. If you can get capital, you should get it. I think it'll help a lot of small businesses, even if it's somewhat expensive. But you just have to make sure, is that a partner that you could live with? How do you find out? Well, it's hard unless you have some experience working with that person or they come through a good referral. But capital is very, very scarce. And if you have access to it, then having some capital is important. The other issue that I see all the time is these small companies in the whole digital transformation services sector have customers that are Fortune 500 businesses with, you know, tens of billions of revenue, and they throw their weight around. So I often see receivables that are 60, 90 days, and that could put a business in a real bind. So as Darin said, that's one of the biggest, you know, risks and pain points that you have to manage very, very carefully. And I've seen businesses that really gave up. They decided to either sell or disband because they couldn't manage their working capital. One thing that I think all of you might think about is, are there any ways to turn your revenue from more of a project revenue to a recurring revenue? And that's hard. but there are ways to do it. I'll say, Darin, what you were doing toward the end of your tenure, that might be worth discussing, because that's one way to create a recurring revenue stream for what is effectively a professional services business.
Awesome.
Yeah, so
Arthur, yeah, go ahead, Darin, and then probably Arthur.
Yeah, just to respond to Steve, the way that we approached our customers for a recurring revenue, we created a product called Flex, which was basically, a large group of different technical and business resources. We allowed the customer to pay, a fixed fee per month. Just think about hours, right? So they bought a number of hours. The difference is that we had somebody who was managing that in an agile way. So we were creating backlogs for the customer and then distributing that backlog work amongst the different skill sets. And then we would burst. And so those contracts for us ranged from $2,500 a month to the largest one was $60,000 a month.
Arthur?
So I guess I'll just hit the three aspects that Steve covered. First of all, to the original question, we all run into cash flow issues. I don't think there's an exception to that. In fact, there's hardly a time when you're not worried about cash. So I don't think it has anything to do with, say, a company being in Pakistan. No matter where you are in the world, that's a services company, global problem. How do you cover it? I think depends on how much the deficit is. So what we did for many years before we raised money eventually was to just use a line of credit with the bank that we banked with. And it wasn't a big amount. I think it was a $50,000 line of credit that we actually used for several years just as a cushion occasionally when we would run out. Similar vehicles can actually be built outside of banks as well, because I understand the credit structure in Pakistan isn't as sophisticated as it is in the US. So there are private entities that are sometimes willing to do a deal with you. And then there is also factoring of invoices and other things that you can actually take advantage of. And then but I think that actually bleeds into something really critical, which is when you raise the money, you need to have a plan. So we did turn down money at multiple times during our journey. And eventually we did end up taking the money, but the difference was why I turned it down the earlier time was because I did not have a plan. I did not know what I was going to do. So I did not let the money being offered drift us into changing who the company was. We raised money when we exactly knew where the money was going to go and we had a plan. And basically, I always encourage founders to say, always build two scenarios, with money and without money. Your without money scenario should always be sustainable, because if your without money scenario is taking you to bankruptcy, nobody wants to give you money. That's a very dirty secret about raising money. Nobody wants to give you money when you need it. So always have a plan of how you're going to run this company without money, and then have a plan B of, if I had this much money, I could turn the trajectory like that. And that's basically the best way to raise money. But also, so if you're offered money, being intentional, knowing where it's going to go, how much you need, how much difference it will make, so you can do ROI calculations on the money itself, if it's worth it or not. So that's just a more conservative approach, but that's what I took throughout my journey.
Thank you, Arthur. I think there's a quick follow-on question. There are two aspects of it. Where should the money be going in a services business? Let's say, of course, we need to have a plan that there is no money, and then we need to grow our services continuously. But then if we have kind of a growth trajectory in front of us and we raise money, what are the key areas that you think should money go into? The question is asked by one of the participants, Zunaira Umar. And then also there's a follow-on question, which I want to ask, probably prepping it up. There's a lot of, I would say, hype around building up a services company, making it stable, getting some revenue coming in, and then start thinking of a product within a services company and building up a product so that your valuation can go high. I would love to pick up on thoughts around this aspect of a typical service founder stuck in a dilemma of services and product together under the same umbrella. Arthur, over to you for the first part.
Sure. So Money in services company, if you raise it, should go towards mainly two elements. Building a talent bench, so you invest more in training, so you hire ahead of the curve, and can open up opportunities to, say, hire younger talent that you can actually train over a longer period of time and pay for that bench cost using that money. And the second use of money, in my opinion, on services company should be sales and marketing. And it's typically always a balance. It's either the cost of bench or it's the cost of lead generation. Fundamentally, those are the two places where services companies' money should go.
And the second part was basically around building a product and services company together. Let's start with Steve, and then we can go to Darin and Arthur.
I think every services company that I have worked with had a product idea, if not a product. So I think that's a fork in the road that everybody arrives at. I feel that, of course, there are many successful product-only businesses and services companies that have converted into a product business. The outcome is somewhat binary. So you could, find a tremendous amount of success, or it could become a pretty big money sink without really ultimately monetizing it. So if you do decide to invest on the product side of the business, make sure that you have a marketing plan and ideally a customer that will buy the product before you sink probably 7 figures of time and resources, because time and time again I have seen people invest many millions of human resources to build a product and not be able to sell it afterwards. Another way to maybe bridge that gap is if you could eat your own dog food, so to speak, where as a services business, you are the #1 user of that product, and it gives you more scalability and leverage. That's one way to build a product business within a services business. And over time, instead of just saying, "Hey, I'm providing a service, using my internal tools," you could use my tools, and I'm gonna charge you a license fee. And that's a progression where you could bootstrap without taking too much risk. But I would say just be very careful about making that decision. In terms of success rates of that conversion, I think only a minority of the companies that I've worked with were able to monetize their product. So that's my personal experience, which is just anecdotal.
Darin, any thoughts?
Sure. So we did have a product. We actually built a SaaS solution inside of SynchroNet, and we had a bit of an identity crisis. Early on, are we a SaaS company or are we a services company? And I think it's important to declare. So you can definitely have products inside of your services business. That is a much different approach on how you want to leverage your capital, how you want to train your team, and what your go-to-market message, than if you are trying to build a product simultaneously with being a services company, right? It is very difficult to build both at the same time. And that's a very nuanced difference, right? But let me give you an example. So when we were building out our SaaS solution, we were thinking about large scale. We were thinking, we were spending time going to conferences around SaaS solutions, and we're really thinking about this as an independent, possibly independent company that we could spin off and those kinds of things. And we really spent a lot of time, energy and money on that platform. And what we noticed is that our services business started to suffer a little bit. And so finally we sat down and we declared, after careful thought, that, we didn't want to be a services company. And so we pulled back a bit on, just our thought about that product. And the product was great. We leveraged it inside of our services business. The reputation of that product got us additional service business. And obviously we were able to get a great multiple of the revenue associated with that SaaS platform because it was, evaluated similarly to the service business. But to Steve's point, I mean, really declaring that you're a services company and you have some products is much different than being a services and product company.
Awesome. Quick thoughts, Arthur?
Yeah, so I think I'd kind of put these in two buckets, right? One case is where you have IP that can assist you in your services and is a differentiator, which can help you get more services revenue, like Darin pointed out. I would call that a accelerator IP. It's not really a product. And I think there's a ton of success stories. We had one as well within the company, but in fact, multiple IP that would be used as a differentiator. But I completely echo Steve and Darin's thoughts. Trying to build a services company and a product company where product has a standalone revenue stream is very, very difficult and frankly, nearly zero success rate. I'm just going to say very boldly. So those pivots typically do not succeed. There's only a handful of exceptions that you can actually point out. The only way I've actually seen it done, I'm sorry, Ajmal, cutting you off, is when people actually spin off a completely independent entity with a different CEO as a product company. And in fact, to be very precisely, what I've seen done is two completely independent companies, whether they own P&L statements, their own CEOs, and between the two companies, there is no fluidity of money or resources. So if the product company wants resources from services company, they have to pay for it. And if the product company wants money from the services company, they have to give equity in exchange for it. So operated like two independent companies, that's the only model I've seen successful.
Sure, very insightful. Two different DNAs, two different minds, two different investing thought process, as well as two different multiple and valuation frameworks. Of course, merging them together will always be a challenge. We'll see some exceptions out there, but generally, it's a tough call. I would want to quickly go to some of the questions from the participants that we have. Question from Shariar Hedri. Services aren't a VC model, but are you seeing some private equity deals in emerging markets where they are hoping to invest in mini Wipro or Infosys? So any thought process around that? Any deals that you see where private equity is playing a role to build up the next Wipro, Infosys in services organizations in emerging markets?
Let me take that. I don't think they're looking to build a Wipro or Infosys, but there are private equities, at least here in the US, that is actively investing in specialty services businesses. The typical minimum size that private equities are looking for, I would say, is say 20 million of revenue on the low end, but ideally bigger than that. So there was a company called Anika that received an investment from Sunstone, and that sold to Rackspace. There was an AWS business. Another example is Griffin Investors out of San Francisco. They invested in a company called 3Cloud, which is a Azure specialist. I mentioned to you DocMation, BV Partners out of Boston made an investment in that, acquired two other businesses, and then flipped it in less than 2 years. So yes, absolutely. But you got to have a certain scale before you attract even micro PEs. And I guess the definition of micro PE is somewhat subjective. But here in the US, private equities are typically looking to invest in something that's worth, say 25 million or more. So if you're a very, very small business, you're unlikely to get private equity attention.
And is IPO a path that you see for a services company, or suggest that one should follow?
I wouldn't recommend that as a path. Of course, there are many services firms that went public, but every public market is different. Here in the U.S., if you're less than $1 billion of market cap, you're a light float micro cap, and there are more disadvantages than advantages of being public. Being public, you're judged harshly on a quarter-by-quarter basis, and I find it that as a relatively small company, you make bad decisions if your time horizon is 1 quarter at a time. So the typical exit actually is a strategic exit where a private equity buys a business, say that's worth 25, and then grows it to a point where it's worth 150, 200 million, and sell to, say, a GSI or one of the international technology service businesses.
Great. There's another question from Taha Jamil. How much role does standardization play for vertical specific services companies to achieve scale? I personally think a lot, but go ahead, Arthur.
Sure. I think I would even simplify that question and say how much role does standardization play? Doesn't matter if it's vertical specific or not. And I think it's a lot. Actually, that's the only way to really scale a services company is to build standardization. And that's not just standardization in delivery. That's a lot of where engineers go first. But it's also standardization of the go-to-market efforts, how you take deals through the pipeline, how you close. The end-to-end journey has to be standardized. That's basically how you scale a services company fundamentally.
Totally agree. Yeah.
Thank you.
And when you standardize services on the delivery side, you also get to enjoy, larger margins. You can do fixed bid. There were some cases where we were in, getting 70% margin on some of our fixed bid services, just simply because we had done it so many times that we could do it quickly with a great customer experience. So, and then to Arthur's point, when we've, created that, and I like to say productizing services, right? So when we productize a service and Mr. Customer, you're buying X outcome, we had that in HubSpot. We knew how long it would take to close. We knew, the sales cycle. We know who was buying those kinds of things, and then delivery was just fantastic. So yeah, really lean into that thought process if you can.
So standardization is a must if somebody wants to grow.
In fact, Ajmal, I would add one more point to what Darin also said, that standardization is also how you get away from the conversation of inputs and into the conversation of value and outputs. That is the value-based pricing. Because for as long as you're talking in terms of people and labor and hours, you're only charging a 30-40% margin, because anybody can go on Glassdoor and see how much you're paying an engineer. And if you're giving them an engineer, why should they pay you more than, say, a 30% markup? But when you start talking in terms of solutions and a process that you are going to be bringing to the table, the labor conversation becomes mute. In fact, we used to sell our services in a way that typically, even after the SOW was signed, the customer neither knew or cared how many people would actually be on the project or where they were sitting. So that would actually lead to us having, on the higher end, we actually had margins all the way up to 85-90% on gross margins. So we'd be taking somebody in Pakistan and billing them at $200 an hour in the US effectively, with absolutely no concerns from the customer, because they weren't buying an engineer, they were buying a solution from Flux7, and Flux7 had a fantastic resume to prove that we know how to deliver solutions.
Very aptly put. Waqas is asking, how do you see the future prospects for an AI-based product tech companies of Pakistan? Product tech, not services. Steve or anybody else?
So I don't know about the last part of the question, Pakistan specifically, but there's going to be a lot of millionaires being minted because of AI products that a lot of people are working on. So I see a lot of future in different applications coming out of different AI technologies. So that's a space that really everybody's focused on right now.
So do you think the geography or the origin of the organization matter here? I think that will cover up the second part. An AI company coming out of anywhere in the world, having a very strong product or service, do you think it will still be in demand?
If the product is good, absolutely. I think it really shouldn't matter. I'm sure there are other, political or marketing constraints of being in one geography versus the other. But ultimately, if it's a good product, then you should be able to sell it, anywhere in the world.
Great. And yeah, Arthur and Darin, feel free to chime in if you have any thoughts around these questions. Another question, what potential do you see between US, Pakistan, and services business? Naeem is asking this question.
Yes, I can.
Arthur, probably do you want to take? Yeah.
Sure thing. Yeah. So because I'm studying this relationship a lot right now personally as well. So I think there is, and again, I do put this as a major premise that you have to get out of the labor mindset and get into the value mindset. And the second thing is be in an area where there is a niche, there is some scarcity. Because yeah, if you talk about like a Node.js company that supplies engineers with a 30% markup and just staff projects for people, there isn't much scope. It's a commodity play, very deeply technical, not a solution provider, just a labor provider. And then when I'm buying labor, I can either buy labor out of Pakistan or Brazil. Brazil seems actually like a better choice sitting in the US. And that's coming from somebody who was born in Pakistan. But the difference is if there's a Pakistani company that's actually bringing a solution to the table, that they're going to take me through a process of actually creating a solution. Node.js just happens to be the technology in the background, but they can turn my digital vision into a reality. That is a lot more value. It doesn't matter that's sitting in Pakistan or Brazil. So the rules, I think, get bent a lot if you are a value player. I guess my classic example is we're all talking on Zoom right now. For all we know, this might be being developed by a team in Islamabad that's sitting in an office in Pakistan, right? None of us knows, cares, or wants to know. We're just using the value of the solution. So that's sort of the mindset in the services world as well, which is it's not about labor, it's about the value that you're creating. And when that happens, a lot of the traditional rules start to go out the door. So that's kind of my way to. So are there challenges? Yes, your buyer pool is smaller, company exiting out of Pakistan, but at the same time, it has happened. In fact, there are many companies I'm aware of where they had teams in Pakistan that nobody kind of even knew about, and they exited just fine without issues. But the key is that those companies were not going to market as a Pakistan labor shop. They were going to market with a solution. I guess one you can look up is nClouds. They had a team in Pakistan, actually exited, and actually exited in the services space. You don't even look at them as a Pakistani company at large.
Yep. Arthur, just a quick follow-on question. What should a new services company founder be thinking right now based out of Pakistan? What should be their sort of thought process or line of sight?
Again, I don't think it's Pakistan specific. I think it's anywhere in the world. If you're a founder of a new services company, my thesis is the meta rule is figure out how you're going to be unique and how you're going to be in the best in the world at something. In fact, within Vixel, we literally call it the best in the world statement. So you have to be very clear in your head on I'm the best in the world at doing X for customer Y using technology Z. And if you have, so that actually is always step one. And then what goes for the technology, what goes for the customer, that's how you create that uniqueness. And that's a business strategy discussion. It's a longer conversation.
Got it. So Hamza Mateen is asking, mostly services companies come from the cost plus costing pricing structure instead of market-oriented ROI pricing. Any comments? What I understood from the question is that typically a service company is thinking about their cost and then just bumping it up for delivering a service rather than thinking of the market demand and potential ROI around that. And then probably building up the pricing structure for that, which also requires a lot of investment upfront in terms of building up that talent pool and addressing that kind of a market demand too. Any quick takes?
I think you go back to what Arthur said around, focusing in on the value. It may cost you $5,000, but if a customer gets the business value and pays $30,000, fantastic, right? But you've got to understand your market and you have to understand the value that you're bringing to them and the competitive environment. We and Flex7 were both enjoying great margins because we understood the value of the services we were providing to the customer, and they were buying an outcome. They weren't necessarily buying, number of hours. So, and listen, that takes time to get to. Right? You're not going to come out of the gate at, hey, let me fix bid this if you haven't done it before. So it takes a little bit of time. You have to understand, but then, do some analysis on the projects that you have completed, right? Is there repeatability and scalability associated with those projects? What was the business outcome that you were able to deliver your customer? And can you start selling that business outcome versus just selling hours, or technical expertise?
Thank you, Darin. Quick question again from Zanera. Arthur, can you shed some light on the accelerator program that you have and how that can or that does support a services business to grow or think in the right direction? I think the first part is already answered. I mean, there's not much VC interest out there in the services companies because they're looking for double-digit multiples out there in a shorter span of time. So go ahead, Arthur.
Yeah, sure. So I think I've kind of made my point earlier in the way we hypothesize and look at the services world going forward. So our accelerator is no exception. It's kind of built from the same roots, which is the first thing we want to do is help these companies find their differentiation. So it's a boot camp, 90-day boot camp with 3 expected outcomes. One, that you create a clear differentiated message of your best in the world statement and of who you are, and a way to take that message to the market. The second thing that we focus on is just professionalize the business, teaching the founders how to run the business. We call that accidental to intentional. How do you turn a services founder that has revenue coming in but doesn't actually know how to grow and what their intent is, turn that into from an accidental entrepreneur to an intentional entrepreneur who has a plan, a forecast, a process, and an operating procedure of running not just the day-to-days of the business, but the strategy of the business. And the third thing is, we already touched on that too, which is a lot of these companies, when we start with them in the bootcamp, are going to market as a labor provider. So turning them into a value player generally leads to a clear, noticeable increase in what they can charge for their services. So those are the 3 kind of the bootcamp values that we create, and that's done through a series of workshops, some one-on-one mentoring, office hours, and a set of offline resources. And then post-bootcamp, we have a couple of years of program where we are just acting as a pseudo board for the company, just meeting with them once a month and just giving them GPS level guidance so that they can stay accountable to the plan we created. Jamil, you're muted, by the way.
Yeah, I mean, I'm very thrilled and excited with all this conversation going on. And I think this can take a few more hours as well. There are a lot of more questions coming up. But I think the time is almost over. And I would like to thank Steve, Darin, and Arthur for very insightful and valuable inputs to all these questions that exist. A lot of folks from this session may be able to get back to you on LinkedIn, connect to you, and maybe asking more questions. Also, I would want to announce that with this session, we are also planning to have a very selected companies workshop in the next 3 to 4 weeks timeframe, or 2 to 3 weeks timeframe, I would say, where Arthur and his team could be able to support us in thinking through how services companies can actually plan a roadmap forward to really improve their valuation process, as well as think rightly in a direction that can help build better equity out there. So just hold your horses. We'll be rolling out the details around the workshop very soon. And then this would be a 3-step process, 2, I would say, sessions around workshop. And the third session would be around how those services companies are able to pitch themselves in a better format, better way, where they could be able to impress and attract their customers going forward in a more mature manner. So once again, thank you so much. Very interesting, insightful conversation. 3 quick takeaways. We have to build niche as a services business. That is very, very important. Typical valuation, if somebody wants to really go to the higher bar, which is 4 to 5x, you really need to be in a very hot area of services like AI. If you are into a typical ERP or Salesforce type business consulting, probably you should look at 8 to 10x of EBITDA. And then again, I mean, in terms of building up your valuation and thinking of an exit, you need to think of at least a year-long plan out there, or probably sometimes even more, building and structuring up your organization in terms of the people, the processes, the standardization, the legal structure, and then, of course, thinking through the right timing as well. And of course, all these folks have gone through this experience, and we look forward to stay in touch. Steve, Darin, once again, thank you so much. It's a pleasure. Your input would be taken along for several service founders to build their services going forward. Thank you, Arthur, for your time.
Thank you.
Thank you.